Hi, it's Nash from Alpha Phi. Please smash that like button, hit subscribe so you don't miss anything. Today, we're going to talk again and look at an example about guarantees on a whole life insurance policy. We're specifically going to look at how those guarantees differ with respect to design. In the previous video, if you haven't caught it, please tune in. We talked about what are the differences between guarantees and non-guarantees or dividends on these policies. The basic answer is that the guaranteed values do not fluctuate with market conditions or financial strength of the company from year to year. They are guaranteed and have guaranteed components to them, such as base premium, the cash value, and the death benefit components of the policy. And it really is important to make sure you're using a financially sound company that has a proven track record of performance over time. This is very key. There are 4 major mutual companies: Guardian Life, Northwestern Mutual, Mass Mutual, and New York Life. They've been around for over a century and not only paid the guaranteed obligations on their policies, but also the non-guaranteed dividends for over a century. Through the Great Depression, Great Recession, all of these hard times, they've stayed financially sound enough to not only fulfill the guarantees, but also the non-guaranteed dividend side of the policies. So, what causes variation to the non-guaranteed or the dividend side of the policies? It's specifically the fluctuations in market and their returns for the company, and those will vary over time, and they distribute those benefits back to policyholders based on those variables. Now, today we're going to dive in and look at varying examples of the guaranteed rate on a policy. The guaranteed rate for this specific product is 3%, and then looking at how does this differ based on design of a policy. Specifically, we have a 40-year-old female, $50,000 for 7 years target funding, and then we're varying the contribution of that $50,000 for basically how much is going into base premium dollars and how much is going into PUAs. There's 2 places you can put your money essentially when funding these policies. Those are the 2 areas, and the results drastically differ. So it's very important to understand and realize what you have when you're opening a policy. All right, as I said, the guaranteed rate is 3% on this policy. Does that mean my actual rate is 3%? No, it does not. These are always gross rates or total rates that the companies communicate, but it's before they subtract company expenses or mortality costs, that sort of thing. So what we really want to look at is the net rate of return going on in our policy. So let's zoom in here a little bit and step through the first example. This is a minimum base premium, maximum PUA split policy. So 10% going to base premium, 90% going to PUAs. So you see $50,000 in the first year coming out of pocket. This gives a $41,902 back into cash value in the first year. That's 84% coming back to cash value because we've maximized those PUAs. In the second year, another $50,000 in, $88,865 in cash value. By year 7 here, we put in $50,000 for 7 years, $350,000 total out of pocket. And the break-even point, when we catch up to that $350 that we put into the policy, year 9, we have $357,802 in cash value. And then you can see the guaranteed rate is kind of fluctuating. This is a year-over-year basis, but you can see the max amount it tops out at is 2.7%, so below that 3% actual guaranteed communicated rate. And that's because of those insurance expenses, mortality charges, that sort of thing. The other thing to point out is that even with this high cash value design, the insurance expenses hit in the first couple years is the worst. And then after that, the policy starts growing and catching up, compounding takes over, it starts covering those insurance expenses and fees, and eventually, like I said, catches back up, breaks even, and then from there it continues to grow. So on a guaranteed basis with $350,000 out of pocket with a high cash value design, let's just highlight age 80 here. We have 741,000 in cash value, 959,000 in death benefit. All right, let's step over to a base premium of 30%, 70% going to PUAs. So base premium 30, PUAs 70. So we've actually contributed less to PUAs, more to base premium. All right, so in year one, 50,000 again, same funding outlay, but only 32,000 in cash value, as opposed to 41,000. That's a 34% hit to our liquidity in year one, as opposed to 16% in the high cash value design. And the break-even point here jumped out about 3 years. So 350 total, that 50,000 for 7 years. We're not breaking even now until year 11. And then you can see that the after funding period, when we're not putting any more into the policy, it tops out at about the same rate. However, if we come down here and look at age 80 again, side by side, on a guaranteed basis, there's only 700,000 in cash value and only 906 in death benefit. So the high cash value design has stronger guarantees. This is because we are putting so much more into paid up additional whole life, which is its own mini contract, immediately paid up, has a death benefit, has a cash value amount, and starts to compound year over year, contributing more and more to the policy. For fun, let's jump over to a 50% to base premium, 50% to PUAs. So, in year one, 50,000 out, less than 50% coming back to cash value, only 48%, 23.9 thousand. Wow, it's really taken a hit again. Again, 3 more years stepping out here in terms of our cash value break-even point. Then let's scroll down here, back to age 80. Do our side-by-side comparison. So remember what we had in the initial 1090 design, 741K in cash value, 960 in death benefit or thereabouts. Now we're down to 657 and 850. Whew, a lot lower. And you can see until we stop funding, we're essentially paying those fees and it's not overcoming those expenses in any of our funding years until year 8. Wow. Okay, and then for the heaviest scenario, 100% going to base premium, 0 going to PUAs, we have 50,000 out of pocket, 3% coming back to cash value, 96.5% liquidity hit in year one. Ouch, that really, really hurts. The break-even point is not until year 20. So way, way out there. What were we on the original design? Year 9. On the 100% base premium design on a guaranteed basis, it's more than double the length of time to break even on your money. It's 20 years in this example. These fees are really, really heavy. And let's scroll out here to age 80. We have even less in cash value, 548 and 708. So really, really impactful. So, really good to understand not only what's going on with the non-guaranteed dividend side of policies, but the guaranteed side of policies on high cash value or different splits of base premium to PUA dollars. You can see here with this progression that the 100% base design, those guarantees push out dramatically. And so you really got to understand what's going on and what you're getting yourself into. I hope this was helpful. Please let me know if you have any comments or other questions that you want to see. I strive for transparency and trying to bring education to the masses. I really hope you enjoyed this, and I'll talk to you soon. Thanks. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.